Assalamualaikum and a very good day to all viewers out there. Today we're going to continue with our MFRS 137 provisions, contingent liabilities, and contingent assets. For information, in my first video, I have already given the lecture on provisions. So in this video, I'm going to proceed with the remaining, which is contingent liabilities and contingent assets. I'm hoping that we can finish off contingent liabilities and contingent assets in this video. So if you're interested to watch my previous video, you can search via YouTube and search for MFRS 137, right? So let's proceed. So our focus here is on contingent liability. So what is contingent liability? So before this, I have already talked about provision, and provision involve obligation that is being recognized. However, there are certain obligation, which cannot be recognized as a liability. As you know, provision is a liability. So there are certain obligation, your commitment either is a legal or constructive obligation that cannot be recognized as a liability or as a provision because it does not meet the 3 recognition criteria. So therefore, if you can still recall, the 3 recognition criteria, right? So the first one is present obligation as a result of past event. So this must be met before it can be recognized as a provision. And you need to go and check whether there is a legal obligation or a constructive obligation. So after that it has been met, you need to check whether the outflow of the resources to settle the obligation is probable. So I've used that OP for outflow is probable. And you also need to check if that is a reliable estimate being made for the obligation. So if all these are being fulfilled, you recognize a provision. You will also notice that sometimes these are not being fulfilled. Yeah. Or maybe these are not being fulfilled. Or maybe these are fulfilled. These are fulfilled, but number 2 are not being met. So these are the situation that we are referring now, which is what we call contingent liabilities. A situation where we cannot recognize an obligation because it does not meet the recognition criteria for provision. So let's go into detail. So let's look at the meaning of contingent liability first, or the definition as given for MFRS 137. MFRS 137 is equivalent, word for word, the same as per IAS 37. Yeah. So the first one is possible obligation. So this cream color boxes are showing the definition of possible obligation and present obligation. So we start off with possible obligation. What is possible obligation? So possible obligation is when the chances of occurrence is more than 5% but less than 50%. If the chances that you will be held liable, our company will be held liable, or our company will have to make an outflow of resources is more than 5%, less than 50%, that is considered as possible. So possible is more than 5%, less than 50%. But that arises from past event. However, the existence of that liability will only be confirmed by the occurrence or non-occurrence of one or more uncertain future event. Let's say something to do with legal proceedings, something to do with the decision made by the court, right? So these are uncertain future events which are not within our control. not within our control. So therefore, this is a possible obligation. And this possible obligation does not meet the criteria for a liability, so it cannot be recognized. So the first part of the MFRS definition for contingent liability. The second one talks about present obligation. So meaning that there is a present obligation, meaning to say that there is a legal obligation maybe, or maybe a constructive obligation. However, that cannot be recognized. The chances are more likely than not to happen, which is more than 50%, which is considered as probable. It is probable, right, in terms of happening. However, the chances here will not be recognized as a liability or as a provision, because maybe the criteria was not being met. So here outflow is not probable. So you can only recognize if the chances are more than 50%. So if the chances are not more than 50% but less than 50%, that is considered as not probable. So when not probable means you cannot recognize as a liability. So provision cannot be recognized. Or if this is met, outflow is probable, you still have problem. You have problem where you do not have the reliable estimates of the obligation. So the 50% percentage are met, but you don't have the amount that you think would be the reliable estimates for you to actually set aside. You don't have that amount. So meaning to say that that is also a liability that cannot be recognized, because either these are not met or maybe these are not met, right? Or maybe both are not met, right? Okay, so sometimes you may also notice certain situation where there is even no present obligation. It's meaning to say that the chances that you will be held liable is very, very slim or very, very unlikely, which is less than 5%. Less than 5% means we are saying that the chances is very slight to happen. And this is what you call remote. So remote means in terms of accounting treatment, there is no accounting treatment. So you do not need to do any adjustment, no adjustment, and also no disclosure. So nothing, just take the whatever in legal suit that you receive and file them. Don't do anything. So let's look at how do we recognize this contingent liabilities. So for your information, contingent liabilities cannot be recognized in the financial statement, meaning that it does not meet the definition of a liability. So therefore, they will not involve any debit or credit to the account. So no debit to the expense, no credit to the liability, because it does not meet the criteria for recognition, right? However, you need to make a disclosure notes to the account. Disclosure note in the financial statement that states what are the nature of the event, whether there is a lawsuit or there is a damage claim, or whether there was a compensation request made by the customers, for example, and therefore the estimates of the estimate of the effects in the financial statement must also be disclosed. So if you do not have the estimate, or the estimate cannot be reliably measured, the facts that it is not determinable should also be disclose. That is mentioned in MFRS 137. So meaning to say that you don't have to do any journal entries, but you need to go and make a disclosure of the effect. The effect of the contingent liability. However, let's say the outflow of resources is remote, meaning that the chances of happening are less than 5%. If the chances of happening are less than 5%, therefore this is considered as remote, and as such, no accounting treatment is needed, as well as disclosure. So that one means no mention that is required for the situation or for those kind of events. So no mention. If the outflow of resources is removed, let's say your director or the legal advisor advise the director and say that the chances of we will be held liable is very, very slim. Therefore, that one will not be mentioned at all. Just file them. Next one is looking at the example. During the year ended 30th June 2000 X8, yeah, this is the reporting date. The year end starts on 1st of July 2007. So this is the reporting date. Okay. One of Bintang Berhad's employees was injured. So when employees was injured, that was actually the past event. So I use red ink to show that part of past event. And past event here is a past obligating event, which is the event that gives rise to a present obligation. And the present obligation here is a legal obligation. Why? The employee that was injured has taken a legal action and asked for a damage claim of 100,000. So they took a legal action. So the first one, probable, so the present obligation, legal obligation has been met. And the second one, if you have to check the second criteria here, the company or the legal advisor is confident that the company will be held liable. Means the outflow is probable. So number 1 and number 2 are met. So will be held liable means the chances that you will be required to settle the obligation is 50% or more. However, the amount payable is questionable, meaning that the reliable estimate cannot be measured. So this means that this does not meet the criteria for a recognition of a liability, a provision. So you are asked to explain the appropriate accounting treatment. So you shouldn't say this is a provision because it does not meet the criteria, the 3 criteria. So this is actually a contingent liability. So you can do the same checklist or the same analysis of present obligation, check the outflow whether probable or not, check the reliable estimate available or not. So if you do that checking, you will see that yes, the first one are fulfilled. There was a legal action filed and there is a present obligation because of that legal action due to the past event where employee was injured while working, not when they are at home, but when it was at the official duty. Second one, outflow is probable because the lawyer said or the legal advisor said that the entity will be held liable more likely than not. Or maybe the lawyer would say there is an 80% chances or 75% chances. That is also considered as probable. Anything which is more than 50%. So it looks like it is a provision, but not so fast. You will see that the reliable estimates cannot be made. So meaning that the third criteria fails. So because of that, you have done your checklist, right? So there is no such thing as a provision. So do not recognize a provision, but disclose this as a contingent liability. Put them in your notes to the account under the heading contingent liability. Explain what are the nature of the event, and what are the estimates of the financial effect. That should be made available by the reporting date, 30th of June 2008, X8, meaning that on the date the financial statement are authorized for issue, maybe in few months' time, by the board of directors. This should be made available via notes to the account. Next, there is also a situation that sometimes it looks like you will have to be held liable, but it's not that. So you have Sunshine Burhat prepared the financial statement for 31st of December 2004, and there was this sales director that was dismissed 15 days before the year end, 15 December, and he filed a claim for that so-called, he said it was an unfair dismissal. So that unfair dismissal was the so-called situation that he said he has the ground to lodge a claim, right? So that compensation of 100,000, right? So there is a legal obligation, because I use purple for legal obligation. There is a present obligation as a result of past event, where the past event is the directors was dismissed by the company, the one in red here. And the legal advisor, however, believe that the probability that the company will lose the case is remote. Remote is normally less than 5%, right? That it has been acceptable. So that was very insignificant. Losing the case means the company will not be held liable. Only that losing the case here refers to the director that has filed a lawsuit, so he will be having the chance of losing the case. So we will not be found guilty. So therefore, his claim was considered as baseless. He thought was unfair, but actually may not be the case. So you are asked to explain this with reason. So if you can see here, remote. Sometimes you may come across this kind of word as well. Very, highly, unlikely. So that also means remote. Or maybe very insignificant. That also can mean the same. Next, we have to look at the answer. Answer 7, right? Not a contingent liability. So that question 7, example 7 is about a situation of having a remote chance, right? So the liability is a possible obligation because it arises from the past event, dismissal, and the liability was the legal suit made by the director. You thought it's a liability. However, the director says so, but to you, you check with your legal advisor, and the legal advisor said that the chances of occurrence is actually very remote. So the legal claim, however, will be determined by occurrence or non-occurrence of one or more uncertain future events. So the court judgment, for example, is the occurrence, and whether or not it will be in favor of us, that is not within our control. So those events are not within our control. The future court case date, maybe the tribunal or whoever that uh, would happen in the future, that is not within your control because it's not you that decide the date or the proceeding. So the legal advisor believes that the success is very unlikely. Because it is unlikely, the possibility is considered as remote or baseless. So because of this, so there is not even a disclosure needed, not even a contingent liability, right? No such thing. And therefore, no action should have been taken. No action, or not even, there is so-called no mention needed. Okay, that's it for our contingent liabilities. I will continue in my next video for the contingent asset. I'll see you when I will see you. I hope you have learned a lot for contingent liabilities, and I will proceed with contingent assets in my next video. Till then, I'll see you.